Hey guys, in this video, I'm going to share the safest investment options that are available to you even if you're starting with $500 or less. These options will give you really good returns and virtually no risk to your capital if you follow the strategies that I'll share to protect your investment. Along the way, we'll talk about some additional investments that people feel very passionate about and see how they fare and if they have a place in your investment portfolio. But before we dive in, there are three important things that I want to get out of the way. Number one, let's talk about expectations. A lot of people expect to go from $500 to $5,000 in a relatively short amount of time, and then to go from $5,000 to $1 million in not that much longer. And I hope that at this point, we all realize that it's a pipe dream and not a reality for most people. Maybe you heard people say that they bought a stock for X amount and sold it for twice as much, or that they invested in a startup and it exploded. And what I want you to understand is that these are the highlight reels. They're not a full picture. What they're not talking about are the losses and the missed opportunities and times that they sold too quick or held on for too long or made wrong investments altogether. And when it comes to investing in startups, statistically, out of 1,000 startups, over 900 will fail. About 50 will survive but remain small. 10 might succeed and potentially become profitable long-term, and only one or less per 1,000 of startups will truly become a unicorn and obtain that really large valuation. So instead of looking for a needle in a haystack that may or may not be there, it's far more productive to focus on strategies that are repeatable. Things that can be and have been done by regular people over and over again. Building wealth is not about luck or finding some secret. It's about consistency, smart decisions, and sticking with the repeatable steps that work. The second thing I wanted to clear up is that in order for your money to start making money, you need a substantial amount of it. 500, 1,000, or even 10,000 is nowhere close to that amount. At an average rate of return of 8 to 10%, in order for you to earn even $1,000 a month, you have to have $120,000 of capital. At any rate of return, if your capital is substantial enough, it will generate growth. Capital is what the wealthy have and is what's making them money. So if you're just starting out, accumulating as much capital as possible is what you should spend your energy on. And don't worry so much about what to invest in or chasing that extra 1% return. And the third thing to understand is that the rate of return on your investment is correlated to the safety of your investment. If you want a high rate of return, the risk of losing capital will be high. If your personal risk tolerance is low, meaning you don't want a chance to lose money, your return will be lower. But there are two ways you can still keep those high double-digit returns and take your risk virtually to zero. And in this video, I'm going to show you how to do that. All right, now we're ready to get into the safest investment options that will bring you decent returns despite the volatility that we're seeing in the stock market today. When looking at these options, we'll rate them in terms of rate of return, which means how much money you make or lose on an investment expressed as a percentage of what you originally invested. Risk, or chance that you could lose initial investment or not get the returns you expected on an investment. Effort, this is how much time and work you need to manage an investment, from simple monitoring to active research and decision making. And liquidity. This is how quickly and easily you can turn an investment into cash without losing value. And to make it very simple, I've put together a guide for you with some extra details about each option and my personal recommendations, so you can download it after watching this video and confidently take the next step. The first two options I'm not going to spend too much time on. It's the HYSAs and the CDs. They both offer about 4% returns. If inflation today is at 3%, this is just a little bit over, a great option to earn a little interest and keep your money safe. Keep it in HYSA first, and then as you start hearing that the interest rates are going to come down, you can move your money to a CD to preserve that higher rate a bit longer, since HYSA rate will go down as soon as the interest rates do. Just make sure that you don't need the cash sooner than the term of your CD, otherwise you can get charged a penalty. Both options are risk-free. because they are FDIC insured. Extra low effort. With a CD, you'll have to figure out what to do with the money once it matures. And liquidity is maximum for a HYSA, but low for a CD because of that time commitment. However, there are some no penalty CDs that still offer a highly competitive rate, so be sure to check out the download to get that recommendation. The next option, and I wouldn't bother with it, and it's not on my list of best places to put your $500, but it has enough buzz around it that I think the video would be incomplete if I didn't cover it. It's the Treasury Bonds. It's like giving a loan to the US government. The chance of the US government defaulting is virtually zero. Rates are close to those of HYSA, but your money is locked up for a really long time. The highest rate here is 4.75%, but the term is 20 years. So essentially, if inflation stays at 3%, you'll be earning 1.75% for the next 20 years. If you sell earlier, you're exposed to interest rate risk. And as a beginner, if you choose to buy a bond, I recommend holding it to maturity, because if you sell before then and the bond price interest rate dynamic is not in your favor, you might lose some of your initial investment and some of the interest that the bond pays. The next option is investment grade bonds issued by corporations. You can get these with any brokerage you are already using. I use Vanguard, and this is not sponsored, but I'll show you what it looks like here. Let's go to products and services, and let's go to bonds. Click on view bond rates. Then let's look at corporate investment grade bonds. Corporate bonds are issued by companies. Corporate bonds carry a little more risk because they're backed by the financial health of the issuing company. If the company struggles or goes bankrupt, investors may lose their principal. Corporate bonds generally offer higher interest rates than the US Treasury bonds to compensate for that added risk. And if you choose investment grade bond, everything rated above BBB, the risk of these companies going bankrupt is pretty low. I know at first this looks intimidating, but if you look closely, it's just the company name and it tells you the maturity date. This is the timeline that you're agreeing to. The coupon is the actual interest rate. I haven't heard of the first couple companies, but going down the list, we have AT&T, Boeing, Sprint. I think we're all familiar with these. We may not know exactly what's going on with them financially, so let's take a look. Let's see what their stock price has been like, and let's check out AT&T. You can do the same steps for others. Looking at AT&T, their stock has held up over the past few years, but there's definitely some serious volatility. AT&T is a communications company, and no matter the market conditions, even a recession, we're still going to need phone service and the internet. So I'll let you decide if you think AT&T will continue to be relevant for the next 7 years. The goal here is to pick a company that will survive past the bond maturity date. Investing in corporate bonds and stocks of the same company is very different. When you buy a bond, you're lending money to the company in exchange for regular interest payments and the promise to get your money back at the end. Bonds are safer than stocks because bondholders get paid first if the company goes bankrupt. Looking at AT&T specifically, their stock doesn't look particularly good or particularly bad, but their bond seems to be offering a really decent rate. So this could be a safe choice with a solid 8.75% return, assuming that they don't go bankrupt in the next 7 years. To do the due diligence, you definitely want to read their latest earnings report to understand their cash flow, revenue, leadership challenges and risks, or you can cheat and use ChatGPT to give you the highlights and analysis. If we were to rate this option across our categories, it has good, almost 9% rate of return, low risk if you pick a solid corporation that won't go bankrupt before your bond matures. Effort here is medium high because you do want to do that due diligence to look into the company financials and the overall sector prognosis, but it's very doable even if you're a beginner. And once the bond matures, you have to figure out what to do with that money. The liquidity here will be low because you will hold on to the bond until maturity to avoid potential loss of interest payments or loss of initial capital. There are also bond indexes, which I'm not including here on the list of best and safest investments. They work just like regular indexes and ETFs, and their return ranges from 1 to 6%. So I would recommend actual bonds instead of bond indexes or bond ETFs. With individual bonds, you know exactly where you're getting a set interest payment and your principal back at maturity, assuming the company doesn't default. With bond ETFs, the value can fluctuate more, and there's no fixed maturity date, which means less certainty if you're planning around a specific goal. The next investment we'll talk about is also not on the list of safest investments, but something that people talk a lot about. It's investing in gold. If we were looking at investing 500 or less, physical gold wouldn't make sense. That's not enough money to buy a solid resellable brick of gold with good gold quality content. But with $500, a gold ETF would make sense. With a gold ETF, you can invest in a group of companies that hold physical gold and track the price of gold, or a group of gold mining companies that track the price of gold and performance of the mining companies. Investing in gold is the same as investing in any single asset. It's a very narrow sector that exposes you to a lot of risk. Investing in gold is not something I would recommend for beginners, but if you're passionate about gold, make it a very small part of your overall investing portfolio. Next on the list is a broad market index or ETF. Index funds tend to have investment minimums while ETFs don't, and you can buy a fund that tracks the same companies in both forms. These are all examples of broad market funds that you can find on your brokerage platform. Historically, S&P 500 delivered 10% returns over a period of time. It's definitely exposed to the market risk, but there is a way to mitigate it, virtually removing all of that risk. In this table, you see S&P 500 returns in 10-year increments. Starting in the 70s, they ranged between 8 and 18%. But in the 2000 to 2010 period, you see that negative return. So if you had money in the stock market at that time and you sold your investments around 2008 market crash, your returns would be negative and you would have lost your returns along with your initial capital. If you had the flexibility to hold on and not sell at that time, things would look differently. Let's look at this table with S&P 500 returns over 20-year increments. Here, we're not seeing those negative numbers because the market recovered after the 2008 crash and was followed by a very long bull market, allowing investment portfolios to recover. And this is essentially how you protect your money from losses, by having a long and loose timeline when investing in the broad market. If you don't have a drop-dead date of when you need the money, you can use market swings to your advantage and convert your investments into cash or other safer investments when the market is up. The effort here would be low to medium. Just open an account if you don't already have one and find a broad market fund to invest in. And liquidity here is high. Another way to protect your initial capital and your returns is by diversifying your investments. If you have $500 or $5,000 or $1 million, you can put some of it in the FDIC insured funds. That gives you a lower return but preserves your capital completely. You can choose to build a bond ladder where your capital is safe and spread across different bonds that mature at different rates. This allows you to have access to a portion of your money while the rest is safe from market fluctuations and still earns interest. And you can spread the rest of your money among some of the riskier options with higher return potential, knowing that you would not sell them unless the market is high so that you get the most returns. Another option I wanted to talk about is dividends. Some people chase stocks that pay dividends, so let's see realistically what that would look like on $500. Let's continue with AT&T. Their share is pretty cheap at $26, and here's their last dividend. So if you invested $500 into AT&T, that would be about 19 shares. So your quarterly dividend would be about $5 for an annual dividend of $20. This is about 4% on your initial investment of $500. If you look at AT&T stock performance over the last several years, it looks highly volatile without a clear upward trend. For comparison, this is what S&P 500 graph looks like. High volatility of a single stock means that you can lose money and that you can't count on steady returns from stock appreciation. On the other hand, dividend ETFs or indexes historically returned a little less than broad market indexes, around 8 to 9%, but offer a slightly more stability since a portion of the returns comes from dividends. They're still exposed to market risk, just like any stock index. Plus, companies can decide to cut a dividend in any given year. The idea of living off dividends sounds very lucrative. So my goal here is to give you a realistic perspective of how much you can get in dividends. Dividends is just a part of the growth strategy in addition to stock appreciation and not a shortcut to getting rich. Let's add it here with the index funds, as it does provide good diversification and a decent 8% return. And the last option I'd like to cover here is investing in real estate. It's not on the list of safest investment options, but it's something that has a lot of buzz around, and I think that it's important to include it here. Obviously, with $500, we're not talking about buying a rental property, but you can invest it in a real estate ETF. While it's just a sector of the economy, it's much wider than gold that we looked at earlier. Real estate ETFs will have companies that own residential, commercial, and specialized types of properties. You have options to invest in the US real estate or go international, or both. You can choose urban or suburban or rural. You can look at growing or declining areas. Real estate is a sector that can be very sensitive to the economy. This sector is highly dependent on debt and availability of tenants to pay rent. So in recession, there may be a challenge in getting the same number of tenants, and trends like remote work may shift profits. Real estate investment trusts are required by law to pay out most of their taxable income as dividends to shareholders. So for this reason, real estate ETFs are often included in broader category of dividend ETFs. So if I had to pick between a real estate ETF and a broad market dividend ETF, I definitely go with a broad market because it gives you more diversification and more stability and a higher return potential. And that's a wrap. Here are your safest investment options that you can go with today, even if you have $500 or less. You can put all of your money into one asset or spread it out and compare how it grows across different assets. I hope you guys found this video helpful. Don't forget to download the guide with additional information, and I'll see you next week.